Hey guys, welcome to this week's episode of the Swyftx Squawk with me, Pav, lead market analyst here at Swyftx, and we're going to take a little bit of a different spin every couple of episodes. While the market it is moving, we're seeing great gains across the market continue to flourish through. Every now and then I do like to just stop and just take stock and look at the market a little bit holistically, almost do a little bit of a retrospective, and that's the theme of this week's episode. I'm hoping mainly that you'll also walk away with just a different perspective on the markets, but I think the real headline for this particular episode is we're going to go into like why 2025 wasn't like 2021. And while that might sound like a pretty throwaway statement, we're going to dive into some fundamentals, some real grassroots economics, and just really articulate why the market never really got as risk on as we did see in 2021. There was a lot of reasons from a news-based perspective. We had the COVID crisis and all that sort of stuff happening at the same time. So this is in no way we're going to see that moment in time ever again. But if we could just look at the crypto markets, which we're going to dive into pretty shortly, look at some historical data, I think we're going to find some pretty interesting new ways to think about the market. And for me, when I reflect even on the last 1 to 2 years, the last 2 years have been so stripped back from a lot of the macro drivers in the market that we're so used to following. A lot of analysts that I'm sure many people follow out there as well, even on the likes of like X and Twitter or whatever you want to call it, have been saying liquidity is rising. Everyone's looking for the same indicators as they were in the past. We've come into this regime where sentiment has probably been, in my opinion, one of the larger drivers on market. And if you traded on sentiment alone, you probably out-traded and invested a lot of people out there. Headlines, like they've literally had such a significant influence on the way that people are making decisions right now. So again, this is taking a different view and perspective, which it's hard to find these perspectives, which is why I'm so keen to share it. That's not all about understanding wars, tariffs, elections, becoming a overnight specialist in oil and supply chain movements. There's a tremendous amount of noise out there, and it's frustrating, right? As an investor, or even worse, as a trader, you adapt to the market as you can, but it's just changed so much over the last, again, 1 to 2 years. Again, that's just my perspective. It's interesting to hear what you guys are feeling as well. But again, this perspective, it's based on how markets think about risk assets relative to what we're going to describe to as a cost base of money. And yeah, I hope by the end of this, it just gives you a different way to think about things. So I really think it's going to be a good one. Now, the overall concept that we're going to talk about today is a little something called real yields. Now, that in itself might sound like a complicated construct, but essentially it's basically working out at what point, essentially, where is the bar for money being less valuable sitting in your bank account and earning just a treasury government yield versus being put into work in the marketplace. And the way that we measure it is basically taking that treasury yield and minusing it from the 2-year inflation expectations. And that's basically what real yields are. They're basically taking one away from the other, and it gives us a line in the sand of, okay, when real yields are positive, basically the treasury yield is outpacing inflation. And we find that when we show you a chart in a minute, that's usually when it's quite a hard environment or harsh environment for risk on assets. But when it's negative, that's when we start to see the environment maybe turn a little bit more risk on, historically speaking. So this also gives us a different way to view things from that perspective. And it all sort of throws back to this particular chart here. So I've overlaid the real yields here, as well as Bitcoin's price movements on a logarithmic scale. And it paints that picture quite clearly. As we move towards a trending down market, particularly when we break that break-even figure, so we move into negative territory, that's what we call, again, like that negative real yield. And when you go back and look at the equation, it's the treasury yield minus 2-year inflation expectations. So what that's basically saying is that in the next 2 years, the market's expecting more inflation than what the government's willing to pay as a treasury rate in your bank account. To what we've seen most recently, which is a positive regime where, again, you're going to make more potentially, or there's less incentive, I should say, to move out of your bank account because the rate of inflation has actually been reducing quite significantly. And when we look at what's happened most recently, since 2023, we've just been on this gradual slope down to this most recent bump with all the, I guess you could say, the geopolitical tensions that we're seeing at the moment bubble up and supply chain issue changes. We're basically waiting to see if this trend's going to continue down or if we're going to see a bit of a reversal and maybe move back to the upside for a little bit. We don't know what's going to happen. But this sort of paints a picture as to why I'm so very pragmatic on following interest rates as well as inflation expectations, because it all comes back to the same equation, right? If you basically keep an eye on these two things and how they're moving, it's going to give a good indication as to what direction or trend the market is moving from a risk on to risk off perspective. So It's pretty interesting when you really start to think about it. And if you don't understand this, just rewatch the video maybe 1 or 2 times. Ask your favorite AI agents to break it down and explain it maybe better than what I did. But I think I did a good job. And yeah, it really is setting up the tone for how to potentially think about the market heading into back end of this year. But that's it from me, guys. I'll be back again next week. Catch you later.